Hello to all participants. Good morning to all those who have joined from the other part of the world, and good evening to all those who have joined from India. So, over the course of next 45 minutes or so, Venkat and I, we will be delving into the topic of taxation aspects of share-based incentives. So, the modus operandi that we have conceived is that we will first be giving a brief introduction, follow that up with the provisions that are there in law. And as far as possible, we are going to be explaining that in very simple and layman language. And then we have put out 3 case studies, which we will be discussing. We hope and we also request that this discussion be as interactive as possible. Yes, indeed, we'll be opening up for questions towards the end of the session. But if you have some questions or if you have some thoughts that you would like to share over the course of our presentation itself, we would be happy to take that up and we'll be happy to discuss. So with that, we'll get into the topic. Now, employee share-based incentives, this is something which today, as we speak, is not alien to any of us. Yes, at some point in time, when ESOPs were beginning to be issued, it was conceived as a novel idea, something new that was brought onto the table. But as we have evolved, ESOPs has become a household name. The reason why this instrument was thought of was that it was felt that there was a need to make the employees of an organization felt more invested in the organization, and therefore it was felt that if one were to confer them with ownership rights in the organization, that would motivate the employee much more than a simple monetary remuneration. So it was with this background that someone had thought that yes, this could be a mechanism for rewarding an employee for the hard work that he is put for the organization. It was also felt that this was also probably helpful in retaining the employee, retaining best performing employees for a longer tenure. So in essence, this is why share-based payment incentives were even thought of in the first place. ESOP is something that we all know. It's an option given to an employee to acquire shares in the organization that he is employed with. And he can decide whether he wants to buy the share, exercise the option, get the share or not get the share. That largely depends on the exercise price at the market price that is prevailing at the time when he is eligible to acquire the shares. But over the period of time, different share-based incentive plans came into being. Yes, fundamentally, conceptually, they are the same, but the models operandi or the modalities are slightly different. Venkat, if you can, take us through the various share-based incentives that are mostly prevalent, throw light on these different instruments.
Yeah, thank you, Bharathi. So on the various variants in which this employee share-based incentives can be rolled out to the employees are broadly can be categorized into 4. Yes, novel ideas will come up and go, but till date, what is kind of more prevalent are these 4 kinds of models. One is the employee stock option scheme, wherein it's a plain vanilla case where a company grants an option to the employee to purchase a particular share at a discounted price, and then which is way less than the price prevailing in the market, and accordingly incentivize the employee. And there will definitely be conditions associated with that option in terms of meeting the necessary targets or being in very fact of being in employment for, say, a specified period of time is will be the kind of host of the certain conditions which can be associated with it. ESPP is an employee share purchase program. So what usually happens in an ESPP is it's a scheme where on a regular or a periodic basis, the employee contributes an amount. say 6-7 months period, he keeps contributing over a period of time, and once that contribution is over, he'll be given an option to purchase the shares of that very same company using that contribution at a very highly discounted price. Maybe say, for example, the contribution is spanning over a period of 6 months. The employee would be given the option to purchase the price at a 15% or a 25% say discount from the market price at the lowest market price during that 6-month period. So effectively on the date of purchase, he'll be able to immediately sell off the stock and then monetize it. So this is what constitutes an employee share purchase program. Definitely the shares will be subject to a lock-in restriction in terms of, because he gets the shares immediately. So they might want the employee to hold it for a period of time before it is sold. Next is RSUs. These are almost similar to that of an ESOP, just that the employee need not pay any amount per se to get the shares. So the shares are issued at a completely free of cost basis. So, and the final one is SARS, stock appreciation rights. This, though, is a share-based incentive, but technically the employee doesn't get a share here. So what he technically gets is the appreciation in the share value in the monetary terms, over the specified period of time. He will get the share appreciation in monetary terms, but nonetheless, there are some variants of SAR where that increase in the share value is also given to him in the form of the shares on the date of the vesting is complete. So broadly, the employee share-based incentives can be categorized into 4 categories as we speak today. So Bharti, before we move into the case studies, can you just throw light on the various the various regulatory provisions which one should ideally have in mind when it comes to an ESOP plan, both from an employer and an employee standpoint?
Yeah, thank you, Venkat. So when we are going to look at the regulatory provisions, let's just keep this example in mind, that today a company floats an ESOP plan, and on the date of the grant of ESOPs, the options to the employee, the market price or the FMV of the share is ₹100. The employees are permitted under the scheme to acquire these shares at ₹10. So there's a vesting period of 3 years, let's assume. Then after 3 years, the shares get vested in the employee. And as on the date of exercise, the fair market value or FMV is ₹110. So 100 on the date of grant, 10 is the exercise price, and 110 is the FMV as on the date of exercise. Now, in the hands of the employer, there is a question as to, can he at all claim any amount as deduction from his gross income in arriving at taxable profits? Why are we even asking this question? The reason why we are asking is, now, if I have to remunerate an employee by the traditional means, then I would be paying him salary in cash. When I pay salary in cash, there is absolutely no question. Yes, it is an expenditure which is actually expended by way of an outflow of money. Therefore, there is no doubt that it can be claimed as a deduction. What is happening here is the employer is not shelling out any penny. Rather, he is incentivizing the employee by permitting him to purchase the shares at ₹10 when the market value of the share is ₹110 as on the date of exercise. Okay. So, yes, share is being issued for ₹10. Employer is indeed getting ₹10. But this is not an ordinary case of share issue at a discount. In an ordinary case of share issue at a discount, what happens is, there is a share, market value is, let's say, same 110. But for whatever reason best known to me, I choose to issue it at a discount. Here, I am issuing at a discount, but there is an underlying reason behind it. The underlying reason is that the employee is rendering his valuable services for me. So it is not a case as we technically call it as issued at a discount. It is not technically being issued at a discount. The way we have to see it is that it is being issued at this price because the employee is being remunerated in a non-monetary form. Now, what is the remuneration for the employee in this case? The value of his services inherently has been determined at 110 minus 10, which is 100. This is what is happening here. Therefore, if we were to look at the transaction of a share issue to an employee in this light, definitely we will arrive at an answer that yes, this may not entail outflow of money, but nevertheless, this is also a transaction where employee is being remunerated for the services that he has rendered, just that the remuneration or the payout is not going in cash. This is the reasoning which was adopted by the lead decision of Biocon, which is now pending before the Supreme Court of India, to say that employer can claim deduction for the ESOP expenditure. Fundamentally, this was the logic that was conceived. Coming to the quantum on how much he can claim, there Biocon said that the income that we will come to the employees part in just a short while from now. They said that the income which the employee is being taxed and the expenditure in the hands of the employer should be one and the same. Therefore, in view of the High Court in Biocon, the difference between the exercise price and difference between the fair market value as on the date of exercise, my apologies, and the exercise price should be eligible to be claimed as a deduction by the employer. Yes, there can be some deviation on what could be the quantum of deduction, but what we have to remember is fundamentally this transaction is not just like any other share issue transaction. This is essentially a transaction where the employee is being paid for the services that he has rendered in a non-monetary form. So if I'm an employer who is going to be conceiving an ESOP scheme, framing an ESOP scheme on my own, then going by the decision of Biocon, I should be eligible to claim deduction for the difference between the FMV as on the date of exercise and the exercise price. There are also situations where there is an Indian entity or an entity outside India, but the ESOP scheme is framed by another entity which could be domiciled in some other jurisdiction. The reason being that that entity, which is a parent entity or some other group entity, could be listed, and by issuing ESOPs from that entity, what is being granted to the employee is inherent marketability of the shares that he will be given. So when those kind of scenarios, notwithstanding the fact that there could be another entity of the group that is issuing the ESOPs, if the entity which is... Sir, you have any question, Mr. Nadu?
Actually, Simachandran has a question. I think he wants to interrupt right now. Please go ahead.
I don't want to interrupt, but I have to. So the question is, when they're calculating the amount of the share price as part of the, I guess, offering or issuance to the employee, what is the basis for that discount? If the person is collecting a salary or some payment, remuneration, why would there be a discount instead of just the market price? Wouldn't they issue the shares at the market price and just prorated for whatever their salary amounts are, or are these predetermined amounts based on some formula that is then administered regardless of what the market price is?
Sorry, I'll just convey what I have understood from the question, so
Okay.
that both of us are on the same page. Your question is, why is the employee not issued the share at the market price itself?
That's correct.
Yeah. Now, if I'm the employer and I have to frame an ESOP plan, as we had mentioned earlier, the reason why I am framing an ESOP plan is I want the employee to have shares in my organization so that he gets an ownership interest. Now, if I'm going to give this share to him at market price itself, that is something that may not motivate him, that may not entice him, for reason that acquisition of share, he can do it in the secondary market. Only when I offer this share to him at a substantive discount, it serves twin purpose. One, it serves as a scheme where I'm able to motivate my employees. I'm able to incentivize my employees. I'm able to give them something over and above what I'm paying them as salary for the services that he has rendered. And when the employee acquires these shares at the price that I have fixed, which is substantially lesser than the market price in most of the cases, what happens is that the employee also, in some cases, yes, there could be a lock-in, etc. But otherwise, the employee is free to sell these shares later on at the prevailing market price and get the benefit from the difference between the exercise price and the market price.
Okay, I get it.
So,
So
if
these aren't shares that are issued in it as a result of salary. They're issued as an incentive. So
yes.
they okay, get it. Thank you.
Yes. Yes. So, to continue from where we left just a while ago, there could be scenarios where a different entity in the in the MNC group is issuing the ESOPs. As I said, that could most likely be for reasons that other entities' securities are listed on a recognized stock exchange. Therefore, secondary market trading bestows liquidity to the employee. And in those kind of scenarios, the primary entity for whose employees the shares are being issued, they still will be eligible to claim deduction in those circumstances where they are compensating the issuer entity, the issuer parent entity, for the maybe opportunity loss or for the value of the share that is being issued to these employees. Now, there is also another model which is prevalent for the ESOP structuring, which is create a middle layer of a trust where a trust is formed. The trust acquires the shares from the employer entity, and later on, the trust will issue the shares to the employees at the exercise price, which is, as I said, substantially discounted from the fair market value. In those kind of scenarios, whatever is the loss that is incurred at the trust level, generally that can be claimed as a deduction. And for the employer entity, again, the amount that is put into the trust, that amount is generally permitted to be claimed as a deduction. So this is as far as the employer is concerned. Employer has one more obligation, which is withholding taxes. Now, an employer in India is required under Section 192 to withhold taxes in respect of any remuneration that is given to the employee. Now, in an ESOP transaction, the employee is also subject to tax. How? We will see in a little while from now. And when he is subject to tax is at the time when the shares are allotted to him. And at that time, because at that time is when the income arises in the hands of the employee, so at that time, the employer will be liable to withheld taxes under 192. So this is as far as employer is concerned. Now, going to employee. Again, quite straightforward, kind of matches with what we logically think of as well. When the employee is allotted the share, there arises income in his hands. Now, what is the quantum of that income? there's a specific provision which says this will be the quantum of the income. Law says that whatever is the difference between the fair market value as on the date of exercise and the exercise price will be considered as income. How do we determine fair market value? Listed securities, quite straightforward. There is a quotation in the stock exchange. We go by that. If it is unlisted, we have to get a valuation done by a merchant banker, either on the date of exercise or at a date which is 180 date prior to the date of exercise. We get a valuation, and based on that valuation, we determine the fair market value. So now, in this example, 110 minus 10, 100 rupees becomes the perquisite for the employee. So he pays tax on this 100 as salary. Now tomorrow, he is going to sell the shares. If he is going to sell the shares, then what happens? Then the actual consideration that he is getting when he is selling the shares, that minus whatever is the fair market value that was considered in determining his salary. In the example that we saw, 110 rupees was the fair market value as on the date of exercise. This 110 is permitted to be taken as cost. Logical reason is you are suffering tax as salary. Therefore, when you are going to sell the shares, I cannot ask you to pay tax on the entire gains considering only 10 rupees as your cost. Whereas you have considered 110 fair market value and you have discharged your tax liability. So it is only logical that 110 be given benefit and you are permitted to take that 110 as your cost and discharge your capital gains tax only on the difference. Now there can be a question. There could be scenarios when the ESOP is not taxed as a perquisite in India. Maybe because that ESOP was given to the employee when he was working outside India, but the shares are of an Indian entity. Since services were not rendered in India, he was not paying tax in India. And he comes back to India, he sells the shares. Now the question can be, now in this scenario, what would be the cost of acquisition? There is no tax liability in India. No tax has been paid in India as a perquisite, as a salary. Here, what we want to say is, even in this scenario, there is merit in arguing that even in this scenario, the employee should be permitted to apply the same logic and not consider the cost as equal to the exercise price, but equal to something more than that. The reason is, this employee is not getting the share at 10 rupees. In fact, he is getting the share for more than 10 rupees. How? 10 is what he pays in cash. The balance he pays through his services. So he gets the share for the consideration, which is a mix of monetary and non-monetary, which is his services. So that service component should also have some value. What could be that value? Yes, that can be a subject matter of dispute. Reason is, the law says take FMV as on the date of exercise only because something is taxed under the Income Tax Act in India. But as nothing is taxed under the Income Tax Act in India, yes, there can be dispute on what could be the value. But there is merit in taking a contention that value cannot be the exercise price. It has to be something more because this was acquired for a value which is a mix of money and non-money. Venkat will also elaborate that in one of the case studies that we are going to discuss. So I will just leave it at this. And I will also touch upon that where an employee is a resident in India and for some reason, because of him rendering services outside India, some portion of the perquisite or the salary relating to the ESOPs gets taxed outside India, then he is eligible to claim foreign tax credit as per rules which are there in India. The eligibility will stem from the double taxation avoidance agreement, and how much of credit can be taken will have to be worked out by taking into account Rule 128 of the income tax rules that are present in India. Now, another crucial point for the employee is that it is not enough that he pays taxes. And this is in respect of all those employees who are a resident and ordinarily resident in India and who have to who have shares of an entity domiciled outside India as part of an ESOP scheme, then this employee is mandatorily required to disclose that he is holding such an asset outside India, and he has to make the disclosure in the annual return that he is filing in India. Yes, and this disclosure is required even if that employee is going to hold this share even for a single day. Now, what happens if they don't disclose that? Then there is a risk of proceedings being initiated on that employee under the Black Money Act, and there's a risk of penalty being levied. Yes, under the Black Money Act, as we speak today, there is a kind of a protection of up to 20 lakhs. 20 lakhs is not just for share. There could be multiple foreign assets. So what disclosure I'm talking about is not the share, not alone the share that an employee may have got under an ESOP and share of a foreign entity. It is in respect of all foreign assets. Every foreign asset has to be disclosed. Bank account has to be disclosed. Any property held outside India has to be disclosed. Any other investment held outside India has to be disclosed. So if the value of all these things put together is less than for 20 lakhs, yes, there is a protection available. But otherwise, yes. So, I mean, generally it is advisable to make this disclosure so as to not invite adverse consequences, especially under the legislation like that of black money, which is one of the bag of legislations that are enacted to counter economic offenses. Yes. And for startups, to incentivize startups, those entities that are set up with a novel idea, which are recognized as a startup for the idea that they have come up with, there is a relaxation which is given that in these cases the taxation is postponed to earliest of the following dates, which is expiry of 48 months from the end of the assessment year in which the shares are allotted, or the date when the shares are sold, or the date when the employee relieves himself from employment. Yes, so this just wanted to touch upon that there is some benefit which is given for startups. Yes. And now we want to just go through some basics of law, not getting into too many nuances in this respect, but this understanding is important for discussion of one particular case study that we have framed, and that's why we just want to roll out certain concepts. Now, in Income Tax Act, I'm not getting into too much technicalities. I'm just going to lay down broad contours. That's it. In Income Tax Act in India, a person, an individual, is classified into three parts depending on his period of stay in that year, coupled together with his period of stay in the preceding years. Let's not get into the nitty-gritties as of now. Let's just leave that there is three-step classification. One is he is considered a resident and ordinary resident, which means he is a full resident. He is completely considered as somebody on whom India has complete taxing rights. There is resident but not ordinary resident, and there is a non-resident. If a person is considered a resident and ordinary resident, depending on his period of stay in India in that year and previous years, then all his incomes that he is receiving or liable to receive from India, from any part of the globe, is subject to tax in India. Yes, of course, needless to say that if his income has suffered tax in some other jurisdiction, then he'll be eligible to claim foreign tax credit to that extent as permitted under law. If he is considered a resident but not ordinarily resident, then income that will accrue or arise in India is nevertheless taxable. Income which may be received in India is nevertheless taxable. Income which is accruing or arising outside India is taxable only if it is from a profession or a business which is controlled or set up in India. So whatever is coming from India, pay tax in India. Whatever coming from outside India, you pay tax in India only if that comes from a business or a profession that is controlled or set up in India. For a non-resident, He pays tax very simply only on those incomes that accrues in the sense that originates in India or that is received in India. Now, I have been using a terminology called accrual. What is meant by accrual? How do you determine when an income accrues in India? We are going to be concerned only about two incomes for the purpose of our discussion today, because the topic is such that we are talking about ESOPs and therefore we are concerned with salary income and capital gains. Salary income accrues in the place where the services is rendered and in the place where the income can be legally enforced. So wherever the person renders services, if it is in India, income accrues there. If it is Australia, it accrues there. USA, it accrues there. For capital gains, it depends on the situs of the asset under question. If the asset is that of an Indian entity, if the shares are that of an Indian entity, then the income accrues in the place where the shares are situated, and situated depends on which entity's shares we are talking about. So this is broad understanding of how individual is taxed. This is required for one of the case studies that Venkat will be deliberating. So we just thought we'll put the kind of layout right at the beginning of the presentation. Yes. With that, now we are going to get into case study. I'm just going to introduce the case, and I'm going to let Venkat give out answers for that. So we are looking at an entity. Let's just say that's Reliance. It has issued stock options for the ₹50 in financial year 15-16. The stocks vest, the options vest across a period of 5 years. And these shares were exercised by the employee in financial year 19-20, on which date the market value is 600. Now, we are looking at two scenarios. One, when the market issue price, or rather the FMV as on the date of grant is 700, and scenario 2, when the FMV as on the date of grant is 500. The question, Venkat, to you is, what is the quantum of deduction that can be claimed by Reliance in this example?
Okay, so Bharathi, here generally what happens is here is where the dispute arises between the tax department and the assessee once they cross the threshold of where the threshold of claiming deduction of the expenditure on account of issuance of ESOP. Once that is decided that expenditure can be claimed, now the dispute which arises is on the quantum. So now generally what happens is companies, when they issue a stock option, they will have to determine an issue price. And from that issue price, they will have to determine a discount, because that is that discount which they determine is the amount which, from the perspective of an employer, which they have valued the service, is the value which they have attribute to the service rendered by the employee. Say issue price which they determine as on the date of grant is 700, and they decide to issue at a price of 50, then it essentially means that I'm valuing the service of the employee as at 650 for the during the course of the vesting period, the employment which he has which he is going to render. Now, same way when the issue price is 500, it means that essentially I'm valuing the service as 450 during the course of the employment rendered during the vesting period. So 50 is, as you rightly said, is paid in cash, and 450 is paid in a non-monetary form of an employment service. Now, from the perspective of your accounting, going by the guidance note issued by the Institute of Chartered Accountants of India and the Ind AS under the company's law, the company would, this difference of between the issue price and the exercise price, be it 650 or 450, the accounting standards say that this is the actual expenditure incurred by you when it comes to issuance of ESOP. So you pro rata allocate it as an employee benefit expense over the vesting period. Now, before Biocon, one of the points that was argued by the assessee is, look here, in a case where I'm issuing shares at 500 and 450 is the expenditure I've claimed, but since the FMV on the date of exercise is 600, employee is taxed on 550. So technically, what is income for another one is the expenditure for another. That is what is the logical conclusion one can have. So what you receive, if it is an income, what I pay is an expenditure, and the amount cannot differ for the payer or for the receiver. If you consider one amount as the income for the receiver, then same amount is said to be the outflow for the payer. Seen in that light, 550 is the actual expenditure incurred by the employer once it is decided that the employer can claim deduction. So rightfully, in a case where the issue price is 500 and the expenditure that has been claimed as deduction till the date of exercise is 450, the Biocon then argued that the remaining 100, which is for which deduction has not been claimed, should also be allowed as deduction. The court said yes, that is logically correct, and that's what it should be, the law as well. And the court also noted that in a case where your exercise price is, say for example, you have claimed an excess deduction, say for example, your issue price was 700, you have claimed a deduction of 650. Now you have claimed an excess deduction of 100 rupees because actual expenditure when it comes to determining the quantum as per this formula is just 550. Biocon says reverse that 100 in the year in which the employee exercises the option. So essentially what the Biocon lays down and the Axis Bank judgment in the case of Ahmedabad Tribunal lays down is the actual quantum of expenditure which would be allowable to the employer is the difference between the fair market value on the date of exercise and the exercise price paid by the employee. To put it short, whatever is taxed as income in the hands of the employee is what is to be claimed as a deduction by the employer. So in this case, depending upon, since the FMV on the date of exercise is 600, the maximum allowable deduction to the employee is 550, and it will not be either 450 or 650. But point to be noted is Biocon is still under consideration before the Supreme Court. On both aspects, one, though the Karnataka High Court has accepted the tribunal's judgment, but they have not gone in depth into the valuation part of it from the perspective of how much should be the quantum of claim of deduction by the employer. But before Supreme Court, both on the aspect of deductibility, whether the is there any expenditure claimed by the employer in the first place, whether it is deductible or not, whether the loss is real or notional, that is also pending. Second thing is also on the quantum. So whatever position we speak today is yes in assessee's favor, but since the matter is pending before Supreme Court, as you would be aware, things can go either way. Yes, Bharathi.
Yes, Venkat. Let's hope that Supreme Court, as and when it comes, it kind of does not, make us revisit all that we have already implanted into our mind on conceptual, reasoning for claiming deductions. On that note, we will move to the next case study. Yes, so I'm going to be laying down the facts. So Microsoft US has floated an ESOP for the group as a whole. So two employees, one Mr. A, who is employed with the US arm of Microsoft, and Mr. B, who is employed with the Indian arm of Microsoft, they were granted options in year 1. And the terms are such that the options would vest upon 2 years of service. The end of year 3, after 2 years, the options vest. In year 4, Mr. A is transferred to India and becomes a tax resident of India. Now, scenario 1 here is A and B exercise the option in the middle of year 4. And because A was all along outside India and year 4 only he comes to India, so in that year, he is qualified as a resident but not ordinarily resident. The second scenario is A and B exercise the options in the middle of year 6, during which A becomes, because he is now in India for a longer period, he becomes a resident and ordinary resident. And B has always been a tax resident in India all throughout. Now, US Microsoft tells India that for the cost of ESOPs, you have to pay me. Therefore, Indian entity pays and US recovers the cost of ESOP that is granted to Mr. B. Venkat, first question to you is from the standpoint of the employer as to whether India will be able to claim deduction for the cost that is reimbursed to USA? And what if that is not done? What if there is no reimbursement? Still, do you see a possibility of deduction being eligible? And also, you may
Yeah.
touch upon the TDS aspects also on that note.
Sure, Bharathi. So, so here the life becomes easier if you ask us, because in this case, what happens is, so generally in an ESOP, as we have discussed till now, is that yes, there is a loss or an expense which has been incurred by the employer when it comes to granting such ESOPs at a discount. And second is also we have touched upon what is the quantum of loss or expense in that particular case. Now, in this case, if you look at the facts, it is when it comes to let's talk about the Microsoft India's case, because they are not issuing the stock option because the shares of Microsoft are listed in US. So if at all the employee wants to get benefited, it's right and appropriate only if the US parent issues the stock option. Now, in that case, whatever is the loss which we are talking about has been or the expenditure has been incurred by the US parent for the services rendered by the employee to its Indian counterpart. Now, ideally, the question would be, since we are talking about US, whether he's allowed a deduction or not is governed by the US tax laws. But nevertheless, Microsoft US would say, see, this is a loss which I've incurred, not for my own business or for my own activities. It's for your expenditure I'm incurring on your behalf. Ideally, you should have paid salary to this extent. We have decided as a group at the group level to remunerate in the form of stock options. Your stocks do not have any value as on date to the employee. Since my stocks have the desired value to the employee, I have decided to issue the stock. You compensate me for that loss. So here, the Microsoft India actually compensates the Microsoft US for the expense or the loss incurred by them in connection with the issuance of this ESOP. So here it's very crystal clear that there is a cash payout in connection with the issuance of ESOPs to the employee B. So therefore, that cash payout is for the services rendered by B to Microsoft India. And since there is an actual cash outflow, Microsoft India can claim a deduction for that while computing their taxable income. Now the challenging part or the difficulty arises when Microsoft US does not claim the deduction or does not recover the cost from the Microsoft India. What we have seen is there have been cases that the group companies at the whole holding company level decide not to recover anything towards the cost, discounted cost of ESOPs from their Indian subsidiaries. And because according to them, they feel that this is more of a shareholder activity. This is because of my economic interest in the subsidiary, I've decided to come out with this plan. So why should I burden the subsidiary with this cost? That's one school of thought which is prevailing. Here, there is no per se recovery that is made. So till here, we are okay because the Indian employer, which is Microsoft India in this case, does not incur any expenditure. Whatever is the loss or the expense, it's for the US Microsoft. But what happens is, as per the guidance note and the accounting standards, in this model also, the Indian employer, which is the Microsoft India, is required to recognize an expenditure in the books of accounts to the extent of ESOPs granted and make an adjustment to the equity in their books. And similarly for Microsoft US, they will have to adjust this cost not in their P&L but in their investment account in their investment account in the balance sheet. So now in this kind of accounting models, the queries which come up from the clients is whether even if there is no payment made, can a deduction be claimed? See, in the earlier case of a direct ESOP, we have established how there is actual expense or a loss which has been incurred. So rightfully, there is a claim to be done. Then rightfully, the employer should be eligible for deduction. in this case, the person who's incurring the loss or the expense is not the employer, but the group entity of the employer, which is Microsoft US. So unless I compensate him, there is no expenditure incurred by Microsoft India as such on their own account. Somebody has incurred that expenditure, but I have not compensated him. It's like saying today Microsoft US says, okay, I have decided at the group level, I'll pay 1 lakh each to the employees of Microsoft India. And tomorrow, if Microsoft India does not compensate US for this 1 lakh, can they claim a deduction? No, because they have not incurred this, though it is for the services rendered by the employee to the Microsoft India. The actual person incurring this expense is Microsoft US. So therefore, in cases where no recovery is made, ideally, one cannot claim a deduction for tax purposes. In this case, Microsoft India would not be eligible for any deduction, despite the fact that your accounting standards mandate such an entry to be passed in the books of accounts. On the aspect of TDS, though it is Microsoft US which is extending this benefit on behalf to the employee, since it is being done at the behest of the Indian employer, which is Microsoft India, Microsoft India is advised or should deduct TDS on this payment when it comes on this incentive when it's making salary payment to the employee, because they continue to be the employer even for this payment, just that they are not in a position to grant this incentive because of certain inherent economic restrictions, since they are piggybacking on their parent entity to grant this. The liability to deduct TDS will continue to be on them for this incentive.
Right. Thanks, Venkat. Now I think we're going to be posing some more difficult questions. Now let us look at employee B. Now employee B, if you can throw light on what is going to be the tax implications in his hand, is he going to be eligible to claim FTC? And more importantly, I want you to throw light on whether there is going to be any TCS liability in respect of the transaction where remittance is going to be made by employee B. So if you can also throw light on the relevant provision just briefly to our audience and then answer that question. And also on reporting obligations, if you can just, again, just briefly tell what is his obligations for reporting.
Sure, Bharathi. So firstly, when it comes to taxation, yes, since the employee B is getting a tax incentive or a benefit, the fair market value of the stock on the date of exercise minus whatever he has paid will be treated as his salary income. Now, since it is an US listed stock, from the perspective of the Indian tax laws, this will be considered as an unlisted security. So therefore, a valuation certificate is required for the purpose of valuing this stock. So difference between the value determined as on the date of exercise and the exercise price will be treated as his salary income. And as and when he is selling the stock, whatever is the fair market value determined on the date of exercise will be treated as his cost for the purpose of computing the gains. That incremental portion will be subject to tax in India as is capital gains tax. But since the share is that of an US entity, and that considering the fact that the share is also located in US, more likely than not, US will also claim the taxing rate on this, and the tax treaty between India and US also provides for it. So whatever is the tax that is paid in US for this capital gains can be claimed as credit by the employee while remitting his capital gains tax in India. He has to file Form 67 within the prescribed time limit, saying that this is the amount of tax that is being paid in US and accordingly claim the credit. Now on the reporting obligations, again, as Bharathi pointed out a while back, since this becomes a share of an US entity, it becomes a foreign asset. As long as the cumulative value of all the foreign assets exceed the prescribed limit of 20 lakhs, he has to ensure that the disclosure is made, otherwise he'll be subject to a penalty obligation. But nonetheless, even otherwise, if under the Black Money Act, but even if the disclosure is not made, he can be subject to general penalty under the income tax law. Now coming to the TCS part, one provision is 206C1G, which is the usual LRS TCS, because that provision, when it got introduced recently, they wanted to track all the LRS payments, and they also wanted to impose a higher threshold. And as we speak today, the higher threshold is 20%. So now when it comes to this ESOP, there are two components to it. One is in a case where the employee is paying the exercise price, that exercise price will be paid to the US counterpart by the employee through the employer. So there we do not have a problem. That is an payment under the LRS route recognized under the exchange control regulations. TCS will be required to be collected as long as the cumulative payment exceeds the 10 lakh threshold. Now, when it comes to that employer part, which is the cost for each share which is going to reimburse the US entity. Now, ideally, that is not the obligation of the employee in India, because that is nothing but the US entity has decided to recover from the Indian entity. That's between two entities there, nothing related to do with the employer. But what we have seen of late and understood practically from the AD bankers is even on that part, there's been a divided position. Some AD bankers have gone ahead and collected tax for each and every employee who are the amounts reimbursed by the employer to the US employer, to the US entity. Some AD banks have taken a position not to collect TCS, and though personally we feel that ideally TCS is not required to be collected on that front, but practically AD banks have taken a call. Some AD banks have taken a call to collect TCS even for the payments made by the employer to their group entity abroad, or the ESOP issued to the employee here. Bharathi, you're on mute.
Okay. Yeah. So this TCS, just for the understanding of everyone, it is similar to TDS, just that instead of someone deducting, someone collects it from the other party and deposits, and like a tax deduction, this can also be claimed as credit. Now, Venkat, my important questions to you are with respect to employee A. Now, we have discussed two scenarios for him. One scenario, he's a resident and not ordinary resident. The other scenario, he's a complete resident. Now, what are his tax implications in both scenarios? Is he liable to pay tax in India in both scenarios? And yes, the allied disclosure requirements also. Which
Yes, Bharathi.
is simple, yes, but major is on the taxability.
Yes, Bharathi. So when it comes to employee A, so what happens is in scenario 1, he is exercising the shares after coming to India and after becoming a tax resident of India, and say in that particular year 4, he is a resident but not ordinary resident. Now, as we spoke some time back, for a person who qualifies to be a resident but not ordinary resident, what is taxable in India is only those incomes which accrue and arise outside India from a business or profession controlled or set up in India, or the income should accrue or arise in India, or the income should be received or deemed to be received in India. Now, when it comes to this salary income, yes, he is a resident, no doubt, but he is receiving it from his US employer, Microsoft US. He is not an employee of Microsoft India, rather he is an employee of Microsoft US. Now, when it comes to accrual of salary income, either it is with reference to the place of enforceability of that income or the place where he has rendered services. Now, when it comes to the place where he has rendered services in US. So therefore, on that front, it is not, one cannot say that it is accruing or arising in India. Second, enforceability, because since contractually the contracts etc. were signed in US back then, if at all he wants to enforce this contract for this income, it will definitely be in US. So on both these fronts, the income is said to be accruing or arising outside India. Now, on the aspect of accrual and arising, one cannot tax this income. the natural fallback for the tax department, if at all could be, is if the salary is said to be received or deemed to be received in India. Now, here, the salary as we speak today is in the non-monetary form, in the form of shares of Microsoft US. Once it is allotted to the employee A, it is still, the situs is still said to be in US. It is still said to be in US. It never comes to India. So since the share is located in US, it is quite but natural for anyone to say that it's been received in US, because at any given point in time, one cannot say that it has come to India. It can never come to India. It can never be said to be situated in India, located in India. So considering that, both on receipt and accrual basis, since he is a resident but not ordinary resident, this income can never be subject to tax for him in India. So therefore, when he is exercising the shares in the year in which he becomes a resident and ordinary resident, one, this income is never taxed for him. Second, the disclosure requirement in the return of income also does not arise, because the disclosure to disclose the foreign assets is only applicable for people who are considered to be resident and ordinary resident. Since in that year he is a resident but not ordinary resident, he need not disclose. But the moment his residential status changes and he continues to hold the shares, he will be required to disclose the same in his ITR. Now, when it comes to the scenario 2, where he exercises the shares post a change, in the sense he becomes a resident and ordinary resident, irrespective of whether he has if the income is said to be accruing or arising outside India or not, this income will be taxable, because for a person who is a resident and ordinary resident, any and every income earned by him is taxable in India. So now, when he exercises at that point in time, he will be taxed in India. He would also be taxed on this income in US because he has rendered services there potentially. So therefore, whatever tax paid in US for the salary income will also be available as credit to him while he is furnishing his returns in India. And naturally, since he is a resident and ordinary resident, the disclosure of that particular asset in the return of income also arises. So because of a change or because of a shift in his residential status, his entire exposure goes for a toss. So that is the point to be noted here. And Bharathi, I think we have already overshot the time. So I think with this, maybe we can conclude the session and also open the floor for questions, if any. Case study 3 is, I think we have already noted.
Yeah, I think, Venkat, we are close to an hour of presentation. I think, yeah, we'll wait for the questions to be posted here.
Yes.
Starting with the first question from Vineet. He would like to know about when is the valuation report from the registered valuer and merchant banker required?
Thanks, Arun.
The valuation report is to be obtained from a merchant banker, and as Bharathi was highlighting, the shares should be valued on the date of exercise, or it can be valued at any time prior to 180 days, anytime prior to 180 days before the date of exercise.
Right.
So this is the time frame we are looking at. So that valuation, that fair market value minus the exercise price is what would be taxed as salary income for the employee. So accordingly, it's better to have this valuation report obtained during this time window.
And just to add
Right.
to what Venkat said, this is for unlisted
Yes.
shares that
Yeah.
are quoted on a stock exchange.
Oh, okay. Of course. I appreciate that part. And why I also asked is because, during our engagements when valuations are required, and just expanding this topic from ESOPs to other cases also, everyone deliberates whether it is for income tax purposes or for Companies Act purposes and all that thing. So, is there a standard way of, like, from a matrix perspective, like if it's for income tax purposes, it is RV, if it is for merchant, Companies Act purposes, it is merchant banker, or does it have to be looked at case to case? I mean, I understand the requirement of valuation has to be looked at from case to case basis, the timing, the way the valuation will be done, but who will be the valuer and what kind of report is required? Is there a standard way out for that or simpler thing for us to remember? Thank you.
See,
Okay. Yeah, Venkat, go ahead.
you are at you are expecting an answer which I don't think at this stage we can provide that, because
Yeah, no worries. We'll connect
no,
later.
no. What I'm saying is, the most favorable answer is not the one which is there in the law. So even within the income tax law, even when it comes to the very same unlisted shares, different provisions have a different manner of valuation. For perquisite, they say go to merchant banker. When it comes to selling this
Understood.
unlisted share, go
Yeah.
determine the valuation on your own account using a net asset value method. When it comes to gifting of this share, again determine based on net asset value method. So I mean, within the same law, we are at a situation where different valuation methods is prescribed, or different manner of determining the value is prescribed. So I mean, the uniformity in valuation within the law itself is not there. So that's when the next question of
Understood.
going across the laws. So I mean, that's how we had.
Pretty fair. Thank you.
Law has to evolve on this front.
Yeah.
Sure.
Venkat, the next question is from Srihari. Tax treatment in case of grant given free of cost. In relation to that, I have a related question. I am not sure whether you can address both of them same time. What about the sweat equity shares given as part of the sweat equity? When especially in the case of a startup, while I do commend you for taking as the segue of things compared to what was prevailing when I was when I passed CA. We never had any issue of shares that too free of cost, and that too by a foreign entity in the 1985 to 88 period. So I think Infosys was just born. So it's very complex, and as it is, even without that, that RN, OR, and resident, normally resident itself, you have a wide number of cases. So anyway, the question is, you please go ahead and answer this. I will come back to my questions later. So tax treatment in case of grant given free of cost.
So see, by grant given free of cost, essentially what we understand is kind of similar to an RSU situation where you don't technically want the employee to pay you any amount. So whatever is the FMV on the date of exercise of that particular share will be treated as your salary income, and the same amount can be claimed as an expenditure by the employer. So if I'm answered your question, or is there something more to it?
Srihari, or if you can unmute yourself, then probably. Yeah, I think that is going. Next one is from Devesh Dasmana. He would like to know where would ESOP lie in case a company files for bankruptcy proceeding, and what will be the process of valuing it? I mean, you can't get your money once it goes for bankruptcy. So I doubt whether, I mean, it's a tricky thing, but in my practically, I mean, please go ahead and answer if you have something on that.
I'd just like to understand this question a bit more. Mr. Devish, if you can elaborate what exactly you're looking at. Like, are you saying that an ESOP is framed, shares are vested, but not allotted to employee, or what exactly is the scenario that you're looking at?
Yes, good evening, ma'am. Actually, I
evening, sir.
wanted to know when company or creditors is formed and the valuation is done, like what are the assets and liability. So how we will determine whether ESOP lies where? How we will calculate it?
I mean, my further question to you is, are you talking about a scenario where that company which is applying for bankruptcy has an ESOP plan?
Yeah, if they are having a ESOP plan for employees and everyone, so like workmen and everyone, so how will they proceed with that? Like where will it lie to calculate the overall valuation of that company?
Okay, see, most likely I'm not able to envisage where they have filed for bankruptcy and that ESOP plan is also still in.
Devesh, while
I think
I would like to add to Ms. Bharathi, it's more on the non-taxation part of it. What in in such a case would be in the NCLT, they will put it as a part of the settlement to be carried over and settled after the resolution is filed.
Okay.
So
Okay.
the banks will take a haircut, but the employee's rights and this thing will get parked. It depends on the promoter, how he makes the plan, and then how he is attached, how he values the employees and those who already hold that money. So it will vest with them, and then they can exit after they come out of the plan. Also, I have come across such practical examples. If that is what you are saying, valuation part of it, you need to wait for the resolution to be approved by
Yes.
the appropriate
I think
authorities.
valuation comes at a later date.
Yeah,
Yes, yes,
exactly,
yes.
exactly. So you will have, and then they can retain it as part of their negotiated settlement.
Yes,
Then
yes. I got my
employee,
answer. Yes,
I
yes, I
hope
understood.
partly it answers your question.
Yes,
I hope. I
yes,
don't know.
yes.
I'm not sure.
Thank you.
Yeah. So honestly, I while I wait for my colleague to do the honors in terms of giving a word thanks for this session. But I think you had dealt a very pretty complex topic, which has got different connotations from the angle of accounting, IFRS, Ind AS, as well as in the hands of employee, employer, and a multiple scenario of fair market value and the price prevailing at the time of disposal and the compliance. I think you have. I do not have a specific question considering so much information has been thrown. I think
Absolutely,
currently I have
Arun.
not dealt with any such a complex situation. But I believe, I think you have put yourself, showcase your talents, and all my our members would be very happy to get in touch. Is what I can feel. What do you say, Vineet?
Absolutely, Arun. I was about to second that. Bharti ji and Venkat ji, it has been pleasure having you. Thank you so much for accepting
Thank
our
you.
invite. And certainly, this topic has global ramifications. Pretty sensitive topic, very close to large community because more than the promoters and the management of the companies, I think the people who are driving this are the real stakeholders, and when they get these kind of incentives which have to accrue in future, and whose certainty in terms of timing value is unknown, I think there's so much apprehensions in place, and you have done a pretty neat threadbare analysis of this topic today. I'm sure a lot of us would deliberate on it further, sleep with it, connect back with you, both in particular and with your esteemed firm. So, really look forward to the opportunity to learn more. Possibly, Arun may want to invite you again in future for a
Absolutely.
detailed
We are already
session
in
once
discussion
we
on
have.
that, Vineet.
Oh,
Yeah,
okay. That's
yeah.
amazing.
Yeah,
Right,
I will
right.
probably get back to you. Probably we'll get to know in a couple of days, probably for the September end. But thing is, the way you have put across the presentation to highlight the
Absolutely.
intricacies that are faced by the CFOs or controllers in terms of what is happening, and as also the cost to the company, CTC. So the adjustments, have to be made into the equity under the OE, other equity, while as a part of it has to be channeled to the P&L. And imagine if your holding company does that, and then you're going to cost it, and then there is a tax collection. So, I mean, it's very, very complicated. So honestly, I do not have a straight question to you from your presentation, but I believe that you've, what do you call, placed the importance and the necessity for dealing this topic, in a very, very calculated and deliberate manner rather than treating it very casually is what I could gather from the presentation. I'm sure my colleagues and friends also would appreciate for a fantastic, from such experienced and talented a person like you, Ms. Bharathi and Mr. Venkat. It was lovely to have you with us today evening. I hope to have you again, of course, on a different topic. So I look forward to that. Thank you. And thanks to Gaurav. I don't know whether he is logged in today. So thanks to Lakshmikumaran and Sridharan, LKS also.
Absolutely. Thanks to
Yeah,
Gaurav. Thanks to
thank
your
you very much,
esteemed
sir.
firm.
Thank you so
And
much. It's
of
been
course, yeah, please go ahead.
yeah. No, it's been a complete honor and privilege for Venkat and I to be part of this session. And in fact, we felt that 1 hour was probably less for a topic
Absolutely.
which is as vast as this, which
Yeah.
probably if we had more time, we would have loved to make it more interactive, discuss much more case
Your,
studies.
your, your case studies, made me recall of my exam days on the taxation. Very cryptic questions on this R and OR and ROR, and citing a few this thing. It'll be just a 3-liner, but you have to break your head to answer that. That's what I could recall. And luckily for me, I didn't have all these ESOPs when I was writing the exam minute. So I would have faced a terrible situation, and spent
Absolutely,
a
I can
lot of time
understand,
for preparing.
Arun. And that's why I was saying it's nostalgic in many sense, right? Very close to our heart in many ways.
Yes.
And yes, this is one of the very few webinars for me in particular I've immensely benefited from. Something to really not just carry forward, but to dwell deeper for our learning purposes, share with others in a more better manner than what we were doing till now as professionals.
Wonderfully presented. Wonderfully presented. The
Absolutely.
case, and then we had the two learned speakers, so the exchange was very, very nice in terms of what is to be presented, and the Q&A with very punchy questions. I'm really happy to have
Absolutely.
engaged.
Last but not the least, thank you to our CEO, Miss Charlotte, who is always at the back end, but always leading us from the front. She just folded her hands because in the background we have the Taj Mahal.
Always,
So she is
ever.
pretty aligned and customized to the Indian way of these webinars. Thank you, Charlotte. Your support really means a lot. I mean, we do these webinars pretty neatly and effortlessly just because you have taken care of everything around it.